Welcome to the Deep Dive. We cut through the earnings call noise to bring you what really matters.
That's the plan.
Today, we're digging into Knight-Swift Transportation's Q2 2025 results. And honestly, this call gives a pretty fascinating look at the current freight market.
It really does. How a major player navigates, well, let's just say evolving conditions. It's quite the case study.
Right. They faced what they called unprecedented volatility. So our mission today is to figure out how they managed not just to survive, but actually put up some strong numbers and what that tells us longer term.
Exactly. It's about strategic agility, focusing on what you can control. We'll unpack the financials, management's thinking, the whole picture.
Okay, let's jump right in with the results snapshot then, because they were pretty compelling. Knight-Swift called it a robust quarter, showed resilience.
Definitely. So top line first, consolidated revenue, if you pull up the fuel surcharge.
Yeah.
It was up slightly, 1.9% year over year. Modest growth there.
Okay, modest revenue growth. But that's not the whole story, is it? The profitability? That seemed like the real headline grabber.
That's exactly where it gets interesting. Adjusted operating income jumped. A lot. 17.2%.
Wow, okay.
Yeah, that's about $15.2 million better than last year.
And that's the key, right? Especially with revenue only up a bit, it screams efficiency.
Operational discipline, absolutely. And look at the earnings per share. JAP diluted EPS hit 21 cents.
Which was a huge jump year over year, like over 60%.
61.5%, yeah. And adjusted EPS, 35 cents. That's up almost 46%.
So this is the third quarter in a row they've improved earnings year over year.
Third consecutive quarter, it tells you they're finding ways to make more profit, not just chasing loads.
And the operating ratio backs that up too, right? Consolidated adjusted OR.
Improved. Dropped 80 basis points to 93.8%.
Lower is better there.
Yeah.
So again, more efficient, more profitable.
Yeah.
Seems like cost control was absolutely central.
Couldn't have happened without it. Okay, so let's look at the big picture they painted, the market conditions.
Yeah, they described it as unprecedented trade actions, lots of volatility in freight flows, not your typical seasonal patterns at all.
Right, and that whole import cliff everyone was worried about.
They said it wasn't quite as sharp a drop as some predicted, but
still general softness in demand, especially on the West Coast. That was a theme.
yeah, they saw a bit of a lift near the end of the quarter, but still below normal seasonal levels. Management really stressed their agility, their flexibility.
Which you absolutely need in this kind of market, being able to pivot quickly.
So how critical was that ability to adapt?
I mean, it was everything. When things are this unpredictable, that's your main advantage. They kept hammering that point, driving costs out, but without hurting their scale or network flexibility.
Which is a tough balancing act.
It really is. They admitted forecasting is still hard work with the policy situation being so fluid, but they sounded pretty confident about being set up for the next cycle.
So how do you stay confident when things are so murky? Focus on what you can control.
That seems to be it. Costs, operations, flexibility. It's defense, preparing for offense later. Makes sense.
Okay, so let's drill down. Segment performance. That's where these strategies really play out. Truckload first, it's their biggest segment.
And it really stood out. Adjusted operating income there was up huge, 87.5% year over year.
Wait, 87%? But didn't loaded miles actually fall by almost 3%?
Yeah.
How does that work? Higher profit on fewer miles.
Great question. It seems counterintuitive, right? But it points to those strategic shifts. The West Coast import lull hit them.
So they move trucks?
Exactly. Shifted capacity to other lanes. That actually led to sequential growth in loaded miles within the quarter.
Okay.
Revenue per loaded mile did dip a bit sequentially, partly spot market weakness, partly less California freight, but they are seeing bid outcomes up low to mid single digits. That points to future recovery.
But the real story is doing more with less, it sounds like.
Absolutely. They cut the truck count, right, by 6.6%. Asset reduction.
Yeah, miles per truck improved.
By 4% year over year. That's 8 quarters straight of utilization gains, getting more out of each truck.
It's incredible discipline. And cost per mile improved, too, for the 4th straight quarter, even with fewer miles.
Yep. Their U.S. Express business margins up 200 basis points just from Q1. It shows the cost cutting worked. Fixed costs, variable costs, both down.
Fixed costs down, absolutely. Keeping cost per mile flat even with lower volume. Variable down through better execution on insurance, claims, maintenance, fuel. Just relentless focus.
That's the name of the game. Okay, let's switch to LTL, Less Than Truckload. Very different picture here.
Big growth story, right?
Huge growth. Revenue, excluding fuel, up over 28% year over year. Shipments per day up almost 22%, and that includes the DHE acquisition they did.
And LTL is now a bigger piece of their overall revenue pie than ever before.
Highest share since they jumped into LTL back in 2021.
The profit side. Adjusted operating income in LTL was down significantly, like over 36%. That looks jarring.
It does look jarring, but it's largely growing pains. They've been upfront about this.
Explain that. Growing pains how?
Well, look at the network expansion. Door count is up almost 28% year over year. That's massive growth.
Okay.
And they made a strategic choice. Maintain service levels while expanding that fast. Think about building out a network you have to hire people, get equipment, open facilities before the freight fully fills it up.
Right. You invest up front. That drags on margins initially.
Exactly. Onboarding staff, getting equipment ready. It puts pressure on margins in the early stages, like building that highway before the cars arrive.
So it's long-term play. What are they doing now to fix those margins?
Multiple things. Pushing sales hard to build density, get more freight moving through those new doors, improving cost per shipment with better scheduling, using tech for planning and routing.
So optimizing what they've built.
Precisely. They expect these efforts to actually offset some normal seasonal margin decline in the second half and then expand margins in 2026.
And they're slowing down the building part. Fewer new facilities this year.
Yeah, they opened 3, replaced 1 in Q2, but the pace is slower now. Focus is shifting to filling up the network they have, optimizing the investment.
Makes sense. Okay, what about logistics?
Volumes were softer there. Revenue down about 2.6% year over year. Load count dropped almost 12%.
But revenue per load was up.
Yeah, up over 10%, which helped offset the volume drop.
And profitability in logistics.
Actually improved, despite lower revenue. Adjusted operating income grew over 13%. Operating ratio got better too, down 70 basis points. Technology. They mentioned investments in real-time quotes, trailer tracking for power only. It seems to be paying off in efficiency and margin resilience, doing more with less again.
Interesting. Now, Intermodal. That seemed like the segment that took the biggest hit from the West Coast issues.
It definitely felt it the most. Revenue down almost 14% year over year.
And the operating ratio worsened.
Degraded by 230 basis points. First time that's happened in 5 quarters for Intermodal.
Ouch. What are they doing about that?
Cost structure focus. They finished converting to private chassis in 5 markets. That should help going forward, eliminates rental and ownership costs for those tandems.
So a specific cost-saving initiative.
Right. And they expect load counts to pick up sequentially from new business wins and as West Coast volumes hopefully normalize a bit. So they have a plan.
Got it. And finally, that all other segments bucket.
Saw decent growth. Revenue up 9%. Operating income surged over 73% year over year. Mostly driven by warehousing and leasing.
A quiet contributor.
Mostly. Though you have to note, there was a $2.8 million charge in there related to some older third-party auto liability risk.
Okay, a one-off item.
And they expect earnings in this category to slow down sequentially in Q4, similar to last year, because of some revenue recognition stuff. Just context for modeling it out.
Okay. So looking ahead, what's the guidance? What are they telling us about Q3?
They gave adjusted EPS guidance for Q3, 36 to 42 cents. That assumes things stay pretty stable, plus some normal seasonality.
And the segments. What are the internal projections looking like?
Truckload operating income, sequential improvement. LTL, modest sequential improvement in both revenue and operating margin.
Wait, LTL margin improving sequentially. Isn't that usually weaker seasonally?
It is. That's the interesting part. They expect growth, yield improvements, and those cost efficiencies we talked about to actually buck the normal seasonal trend. That's a bullish signal for LTL optimization.
Very interesting. And logistics and intermodal.
Logistics expected to contribute similarly to Q2. Intermodal expected to improve its operating ratio, cut its loss as volumes recover and those cost initiatives bite. So generally pointing towards continued operational gains across the board.
And they trimmed their capital spending plans for the year.
Yeah, full year net cash CapEx projection is down a bit. Now $525 to $575 million.
Why the cut? Pulling back on growth?
Not really on the core fleet. They said it's mostly adjustments in facilities and IT spending. Their basic equipment replacement strategy hasn't changed. Seems like smart optimization of investment dollars.
Okay, shifting gears a bit to the broader investor context. What are they seeing out there in terms of supply and demand?
Management thinks capacity is slowly but surely leaving the market. They're hearing about failures, anecdotally.
Not just the tiny guys.
No, including some decent-sized fleets. That's a shift.
And what about customers? How are those conversations going?
Apparently more stable than a quarter ago. less reaction to tariffs, and importantly, they're starting to talk about potential peak season projects.
Ah, so demand for reliable capacity might be firming up.
That's the implication. One-way capacity at scale seems to be getting scarcer, more valuable. They saw the usual post-July 4th softness early in Q3.
But then
Things picked up more strongly than expected late last week and this week. So the feeling is the market is tightening. Maybe the worst is behind them. Cautiously optimistic, I'd say.
okay, let's talk truckload margins again. They reiterated their targets, mid-80s OR mid-cycle, low 80s, 70s at peak, upper 80s when it's tough. Is that still realistic?
They think so, and their strategy backs it up. Focus right now is nailing down the cost side, the part they control. That positions them perfectly for when the market turns.
And rates.
They're seeing low to mid single-digit increases in the current bid cycle. Plus, any project business later this year could provide upside and set up a better bid environment next year.
And they feel they're better positioned than competitors now.
Especially for one-way service, yeah. Adding U.S. Express and other brands gives them scale to solve those urgent customer needs that smaller players can't handle, leveraging that network.
Makes sense. And back to LTL for a second. After all that expansion, the acquisition, it's a much bigger business now.
Scaled significantly, new services, wider market access.
But the scaling itself caused headaches, beyond just the cost.
Oh yeah, system integration, changing processes, merging cultures, that all created cost headwinds during that rapid growth phase.
So now the focus is?
Intense focus on optimizing operations, using tech, aligning resources, getting those margins up while still growing into the network they built.
And pricing discipline is holding.
Seems so. Revenue per hundredweight's still growing nicely. They even see potential to catch up more with industry leaders on pricing over time.
And they mentioned using trucks from another division.
Right. Using day cabs from their truckload dedicated fleet for LTL runs. That's a smart synergy. Fuels LTL growth without needing a big jump in LTL-specific equipment CapEx next year. Very efficient.
Clever. Okay, one more market point, transparency. They talked about how much more price visibility there is now compared to, say, 10, 15 years ago.
Yeah, driven by all the third-party data customers have access to now.
What's the impact of that? Does it just squeeze everyone?
It definitely makes market cycles faster, more efficient. Everyone sees rate movements quickly and reacts, but it fundamentally changes the game between big asset players and brokers.
How so?
Their view is that brokers really depend on lots of small carriers being available. As capacity exits, they think more brokers will exit too.
So consolidation favors the bigger players.
Seems to be the idea. Customers use spot market data from brokers in negotiation, sure. But Nightwift is seeing customers come back to them with mini bids for lanes where a broker or smaller carrier failed, often at higher rates.
Interesting. So transparency doesn't necessarily kill margins for the big guys?
Not inherently, no. They pointed out they had strong margins during the COVID era, which was also highly transparent. At the end of the day, they argue, supply and demand still rules pricing. Discipline and scale matter more.
All right. That brings us nicely to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea. Just thinking out loud here.
Okay, let's brainstorm. Given everything we've discussed, Nightwift's execution, LTL focus shift, cost discipline, what's the catalyst?
Well, the market seems to be slowly tightening. Capacity is leaving. Nightwift is deliberately slowing LTL build-out to focus on efficiency, getting ready to leverage that huge network.
And they've crushed costs in truckload. Plus, they expect LTL margins to improve against seasonality. That hints at serious operating leverage when volumes really come back.
Okay, so here's the outrageous idea. What about going long Nightwift equity and pairing that with a short position on a basket of smaller, regional, asset-light freight brokers?
Okay, I see where you're going with this. The thesis being?
The thesis is, as capacity tightens and maybe demand firms up, life gets harder for those asset-light brokers who rely on lots of small carriers and a fluid spot market. The easy money dries up.
Right. While the big, disciplined, asset-based players like Nightwift, with their scale integrated network, remember those LTL truckload synergies and proven cost control.
They disproportionately grab share and pricing power. Nightwift's long game in LTL, which hurt margins short-term, sets them up for a potentially massive profit rebound as that network fills.
And the squeeze on the smaller, maybe less disciplined brokers just amplifies Nightwift's relative strength and future margin potential. It's a divergence play. Outrageous, but plausible.
Plausible indeed. So let's recap. Nightwave Transportation Q2, impressive operational discipline, strategic thinking in a really tough freight market.
Delivered strong earnings, yeah. Driven by cost control, but also that aggressive forward-looking LTL growth, even with the short-term margin hit.
They're clearly positioning themselves for a tighter market, driving efficiencies everywhere, truckload, LTL, logistics, ready to unlock that operating leverage when volumes turn.
Definitely playing the long game.
Now remember everyone, this deep dive, it's purely for informational purposes, definitely not financial advice. Always do your own homework before making any investment decisions.
Absolutely critical.
And thinking about these market dynamics, what data points would you be tracking to confirm this capacity exit? Or the demand stabilization they talked about? Are there other signals you watch?
Yeah, what confirms this tightening? We'd love to hear your thoughts. Send us your insights, your questions on this deep dive.